So in the first lease webinar, we kind of went through the basics of the lease accounting. In the second one, we went through an action plan, some of the actionable steps that you can take, and walked through a little bit more complex examples. This particular webinar technically is building upon those first two, and it is very much a little bit more technical than the other ones. So if at any time it feels like, it's a little overwhelming or the material may be a little bit more complex, my advice to you is, kind of listen through the webinar. Once you get a copy of the presentation, use the examples to kind of guide you through what the theory is saying. The examples were given to you with a lot of the key numbers to be able to kind of walk through and understand technically what's happened or what's happening or what we're trying to describe. So if you feel like it's a little bit technical as you get into the webinar, don't worry. It probably will feel that way to everyone. So I think, really taking a look at the examples after the fact, that will definitely help you. And if you have questions on anything that we have throughout, even after getting the presentation, of course, you can always reach back out to me. So we're going to go ahead and get started. So today is the presentation on special considerations. What we're going to cover today is lease modifications. So if you've already have a lease asset, right of use asset, lease liability on the books, what happens when there's a modification in that lease before that lease has ended? We will go through it from a lessee's perspective as well as a lessor's perspective. We will cover lessor accounting. So a lot of the accounting for the lessor has not changed with the new lease accounting standard. There's a few key changes that we will go over with you, but the biggest change in the lessor accounting is really those lease modifications. So again, we'll go over lease modifications from a lessor's perspective. We're going to touch upon embedded leases and some related party considerations. I know we've kind of touched upon some of these topics in the first two webinars. So we're just going to revisit that again at a little bit more detail to kind of help you out. And then we're going to wrap it up with a sales leaseback transaction and what that looks like under topic 842. So lease modifications, what do you need to know from a lessee's perspective? The first thing you should ask yourself from a lessee's perspective is there's two conditions, and both conditions need to apply in order for that lease to be accounted for as a separate contract. So there's two options. There's to account for the modification as a separate contract, or there's to account for the modification as a remeasurement of the right of use asset and lease liability. And we'll go through two different examples. But the first question you have when you have a modification that you should ask yourself is, do both of these two conditions apply? The first being, is there an additional right of use? Is there an additional asset, additional property, office space? Does that condition apply? Is there an additional right of use? If the answer to that is yes, then go to the second condition. Are the lease payments increasing? So in addition to that right of use, do you have an increase in the lease payments to kind of reflect the fair value of that additional use? If both of those conditions apply and your answer is yes to both of those, that would be considered a modification that would be accounted for as a separate contract. And I will get to that in a little bit in example one that we'll walk through. So actually, let's walk through that right now. So in that first example, the lease has been modified. So the original lease was a 10-year lease at $50,000 per year. At the beginning of year 7, the lease was modified and the lessee got an additional floor of office space with the modification. In addition, the lease payments went from $50,000 per year to $97,500 per year. So that is an increase in the lease payments of $47,500. So now instead of one floor, they have 2 floors, and now they're paying an amount of $97,500. So what were our two conditions to determine if that additional should be accounted for as a separate contract? Is there an additional right of use? Yes, they have an additional floor. Is the lease payments increasing? Yes. The allocated amount, or the increase from the original 50,000 is the 47,500. So both of those conditions apply. So therefore, we're going to count for it as a separate contract. What does that mean? That means that the right of use asset and lease liability from the original lease would still be amortized the same way you've always treated it. So that lease liability would be accounted for the same way. The right of use asset would be amortized the same way for that 50,000 under that original lease. But we're going to take that 47,500, so that incremental increase, and we're going to amortize that over the 3-year remaining term using the discount rate, if it's not stated in the lease, using the discount rate at the modification date. So we're going to create a new separate right of use asset and lease liability that we're going to amortize over the remaining term. And I won't go through the accounting of what that looks like. As mentioned, you can go back to lease webinar 1 or 2, and that'll give you the details on how to account for that. So the next step is in the case where it is not a separate contract. So you don't have an additional right to use, or there isn't an increase in payments. The first question you should ask is there a decrease in the right of use? So are you losing office space? Are you losing a piece of equipment? In that case, you may have a gain or loss. So moving down in the box, yes, there may be a full or partial early lease termination, or you may have to decrease the amount of the right of use asset. In the case of no, you would adjust the lease liability and record the offsetting change to the right of use asset. So in both those cases, we're going to come to that middle box. So that just kind of describes what the accounting is going to look like. And that middle box was the original lease a finance lease and the modified lease an operating lease. We'll come back to the yes, but if we determine it isn't in either or both of those cases, you're going to continue to apply a remeasurement. So we're going to have to remeasure the right of use asset and lease liability, and then we'll continue to follow the guidance for the accounting as normal. And I'll walk through that example in example 2 that I'll walk through. In the case that it went from a finance lease to an operating lease, and I'm going to go to that little a, in that case, you are going to do a calculation to determine if there's a prepaid rent or lease incentive. So in short, you're going to take that carrying amount of the right of use asset immediately after that modification period, and you're going to compare that to the right of use asset that would have been applied if it was a new lease. And you're going to compare the two, and between those two, if you have a positive, it might be a prepaid rent. If you have a negative, it will be a lease incentive. And I'll walk you through that example in example 3. Again, it's a little bit, harder to understand the theory behind it. So we're giving you some detailed examples to kind of walk through what this is trying to say. So let's go through the first example 2. So in this case, so we had an original lease of $100,000 annual payments, 5-year term. It has been modified at the beginning of year 4 to extend it for 3 additional years. No additional right of use. So if we go back to, is it a separate contract? Because there's no additional right of use, it is not a separate contract. So in this case, they're extending the lease term. So it's a modification. The new modified lease has annual lease payments of $110,000. So the lease payments did go up. And then to mention, the right of use asset immediately before the modification was $199,238, and the lease liability was $195,238. So moving over to the right side. So as we mentioned, we have to remeasure our lease liability and right of use asset. So we're going to do a calculation to calculate the present value of the remaining future lease payments given the modified terms, using the discount rate as of the modification time. So the incremental borrowing rate in this case was 6%. That's the discount rate we're going to use. That would calculate to a lease liability of $491,162. So I'm going to compare my new lease liability with what my original lease liability was on the books. And now I have to record an entry to increase my right of use asset and increase my lease liability by $295,924. Now in the little blue box, I gave you an example so you could kind of see how we would do the accounting for the lease expense, right of use assets, obviously making those lease payments, and then how we amortize off that lease liability. Again, producing a schedule like this might help show how each year, as you make each payment, how all of those right of use asset and lease liability would be amortized off. One thing to mention, and it's always the case, is that lease expense. Remember that lease expense needs to be a straight line. So you can see in the case of what we're looking at, we're going to start with the amount, the 550, so the 110 for the remaining term, the 5 years. And we're going to add to that, and I mentioned this and I kind of put that $4,000 in there. What is that $4,000? Well, if you look back at the original lease up to the left-hand side, you can see I had initial indirect costs of $10,000. In the first period, the first 4 years, I amortized that off $6,000. So I still have initial direct costs of $4,000 left that I still need to amortize over the new period. So even though I'm remeasuring the lease liability, the right of use asset, I still have to account for those initial direct costs that haven't been fully amortized. So when I look at both of those numbers divided by 5, my lease expense is going to be $110,800. You can see in that little blue box, I now have my right of use asset, which is the $495,162, which is really that $199,238 on the left-hand side, plus my $295 adjustment. So now I'm amortizing off that $495,162, and you can see how my lease liability gets amortized off. Again, it's a very detailed example. It may make sense to go and review it back after the lease webinar. A little bit more complicated, I'm going to get into example 3. So this is taking a finance lease, and now the modification will turn it into an operating lease. So looking over to the left-hand side, I have a 10-year lease. My lease payments start at $14,527 with a 3% increase per year. So what I did in that box to the left is kind of show you what those lease payments look like the first 6 years. And why did I do that? Because at the end of year 3, there's a modification to reduce the lease term from 10 years to 6 years. So looking at the modified lease, I'm really going to focus on the red part, which is at the end of year 3, the carrying amounts of my lease liability is $83,651. And my right of use asset is $73,500. Now, given all of these terms, I can see that my finance lease that was originally in place is now an operating lease. Looking over to the right under number 1, you can see that now, because of the lease term and the remaining economic life, I have to classify it as an operating lease. So that modified lease is now an operating lease. What does that mean? So let's take a stab at step 2. We're still going to remeasure the lease liability and right of use asset. So again, I'm going to look at that lease liability by taking the remaining payment terms at the discount rate or the lease rate at the modification date over the remaining term. So now my revised lease liability is $39,194. I had $83,651 on the books. So I need to adjust my lease liability by $44,457 or reduce it. You can see over to the right, I had property, plant, and equipment on the books initially as $73,500. I now need to adjust that by $44,457, what I adjusted my lease liability. And then instead of equipment, it's really going to be that right of use asset now. So I now have a right of use asset of $29,043. Continuing on in that example, that slide that came with the little letter A that kind of talked about that lease incentive or prepaid rent. So here's kind of the second part of it that we'll actually walk through that example. So as mentioned before, now that I've remeasured my lease liability, my updated right of use asset is the $29,043. Now I need to calculate that right of use asset as if it were a brand new lease. So taking into account the lease payment terms, the discount rate, the remaining term. In this case, there were no initial direct costs. So my right of use asset, as if it were a new lease, will match my new lease liability, which is the $39,194. So you can see here, I have a lease incentive of $10,151. So the second part, going down below, I take the remaining lease payments for the years 4 through 7, and you can see those lease payments would be the $49,065. I reduce that by my lease incentive, and my lease expense over the remaining 3 years is going to be the $38,914. And you can see in the blue box, I kind of gave you the details for those last 3 years to kind of help support the numbers that I'm providing you. So you can see my lease expense, again, needs to be straight lined over the period. So I take that $38,914 and I'm amortizing that evenly over the 3 years. Obviously, the interest is based on the lease liability multiplied by the discount rate used. That will tell me what my right of use asset amortization is. Remember, my updated right of use asset was $29,043. So you can see over the 3 years how I amortize that off. You can see my lease payments, which were that, that initial $14,000 with the 3% increase each year. So you can see my lease payments there. And then my lease liability, which was $39,194. You can see how I'm amortizing that lease liability down. Again, in that blue box, I tried to give you like all of the accounting for the first 3 years, so you can see how each of the pieces relate and how they amortize off. So again, going to mention, I know this is very technical. I know this example may be confusing at first, but what I recommend is kind of looking at it after you get the slide deck, looking at the numbers in the blue box to kind of help, make sense of how you are, adjusting for that lease incentive or that prepaid rent. If you ever have an instance where you have a lease modification like this, please talk to your accountants, your auditors. Just, make sure that, if you want, you can reach out to me. I'll walk you through it. But you want to make sure that your auditors are also aware of the counting that you're doing and the different things. So please feel free to share it with them. And then before I turn to the next page, I'm actually going to give you your first keyword of the day. So today is National Homemade Bread Day. So I love to do my keywords with the national holidays. Your keyword will be bread. But hopefully you can go home and enjoy some national homemade bread with dinner, or stop at Panera and maybe pick up some homemade bread. They make it homemade. So your keyword today will be bread. And now I'm going to turn it over to Samantha, who's going to walk us through Lessor accounting.
Thanks, Kristi. So now we're going to switch gears and focus on the lessor side of things. So overall, fundamentally, it has not changed under 842, but there are some differences, and those differences are primarily what we'll focus on. So the first thing we're going to touch on is the lessor lease classification. This becomes an important topic once we get to lessor modifications. So I wanted to give an overview of this topic first. So the first thing you would do is to determine if, again, on the lessor side, your lease is going to be a sales type lease. So that would happen if any of these criteria at the top are met. So transfer of ownership, if the lessee has a purchase option that is reasonably certain to be exercised, if the lease term is for the large part of the remaining economic life, if the present value of the lease payment plus any residual value guarantee is equal to or greater than substantially all of the asset's fair value, that would be a sales type lease. And then finally, if the underlying asset has no alternative use to the lessor, all of these would be criteria that you would classify your lease then as a sales type lease. If none of those are met, you kind of move to the second part of the test, which is at the bottom. So then you look at if the present value of the lease payments plus any residual value guarantee from the lessee or a third party That part is in yellow because that is what differentiates this test from the criteria in the sales type lease. So it's adding in, you can now include any residual value from a third party. So if those two factors are equal to or substantially all of the underlying assets fair value, then you move on to the last step, which is just about collectability. If it's probable that the lessor will collect the lease payments, yes, then that is going to be a direct financing lease. Again, both of these two components need to be met. And then if any of these are not met, it defaults then to an operating lease. So to continue on, we'll touch on a few more things on lease classification. Overall, if an operating lease was an operating lease under 840, it will most likely remain an operating lease. There will be a lot of direct finance leases that will now be considered a sales type lease. So that is a change. However, the accounting impact will not be significant typically. Another change I want to point out, you can see it is in red and starred in both the chart and the bullet points, is that selling profit under a direct financing lease will be deferred and recognized over the term of the lease. The concept of deferred selling profit didn't exist under 840. So again, that's just something I want to call out as one of the larger differences in lessor accounting. And so we won't get into detail on all of this, but you can always look back and refer to this slide. And so now we'll kind of go over a few more things in lessor accounting that have changed before we get into our modifications. So again, just a couple additional things focusing on only the things that are really changing under 842. So just like the lessee, the lessor has to separate lease components from non-lease components and then allocate consideration. There is an option to elect the practical expedient, in which case you could combine lease components. Executory costs no longer exist under 842, so that's a difference. Initial costs have a narrow definition under 842. So although the population has changed, the accounting has mostly remained the same. And then expanded qualitative and quantitative disclosures, that's consistent with what 842 did for lessees as well. So again, just expanding on both sides for your disclosures. And then the main change under 842 on the lessor side is lease modifications. So that's the next topic we'll kind of jump into and will be a significant portion of the lessor accounting. So lease modifications on the lessor side. So the first step, we kind of broke this out into steps. And the first part is, again, you're going to apply that same key question that we already discussed on the lessee side, which is, should the modification be accounted for as a separate contract? So the two criteria would have to be met for the answer to be yes. And that is an additional right of use asset being granted. And also there needs to be an equivalent increase in the payment. So if those two criteria are met, then you account for it as a separate contract under 842. If those criteria are not met, you would move on to step 2, where you're going to reassess the lease classification based on whatever the modified terms were. So that's kind of why we spoke to the classifications on the lessor side earlier, because for step 3, whatever you determine the modified lease classification to be is going to impact how you will account for that under the new modified lease. So now we'll jump into specific modifications under each type of lease. And again, as Kristi's noted in her sections as well, this is a lot of information and a lot of new technical changes. So I think the examples will help kind of put together what I'm going to talk through. So for operating leases, if the operating lease remains an operating lease, so you looked at the modified terms of the lease, and it's still considered an operating lease, no gain or loss is going to be recognized, and you're going to calculate a new straight line lease income based on the modified terms. If the operating lease is modified and is now going to be considered a sales type lease, the net investment in the lease is going to be adjusted to the fair value of the asset. If the operating lease is modified into a direct financing lease, the net investment at the date of modification is going to be adjusted to the lessor's carrying value. So now we're going to talk through an example of an operating lease modification so that you can kind of see how this would be applied. So in this example, it's an operating lease that is going to remain an operating lease even after the modified terms. So at the top here, you can see the original lease terms. It's a 4-year lease of a crane, and it was originally broken out to 2 components, one lease component and a non-lease component, being the maintenance, the allocation was performed, and then at the beginning of year 4, you have a modification that's going to extend the original lease by 2 years. So your 4-year lease is now a 6-year lease, and your annual payments have increased to $70,000, and that's where both components total. So if we apply the steps that I just kind of talked to a few slides ago, so step 1 is to consider if this should be accounted for as a separate contract. So there has been no additional right of use granted. It's just an extension of the lease term. So we are not going to account for it as a separate contract, and we'll move on to step 2, which step 2 is reassessing the classification based on the modified terms. So here, based on the modified terms, there was nothing changed that would make this lease become either a sales type lease or direct financing lease. The lease term isn't a majority of the remaining life, and same with the present value. It's not substantially all the fair value. So it's going to remain an operating lease, and then you know what type of accounting to apply. So in this case, the lessor is going to reallocate the consideration to both the lease and non-lease component, since we did have 2 components in this example. So $70,000 is your new annual payment for 3 years that are remaining on the lease term is $210, as you can see in this little box at the bottom. So then you'll allocate the $210 to the lease component and the non-lease component. So your new updated lease component is going to be $193,200. And then the second part to the accounting is recognizing lease income of $64,400. And that's the $193 over the 3 years. And then the maintenance income, which is the non-lease component, will be recognized under the guidance in topic 606. So that kind of is wrapping up the operating lease modification. And now we'll move on to, if you have a direct financing lease modification, what that looks like on the lessor side. So again, the accounting is dependent on how the lease is classified after it's modified. A direct financing lease that is modified to an operating lease, the lessor is going to recognize the underlying asset at the carrying amount immediately before the effective date of the modification. If the direct financing lease is modified into a sales type lease, you're just going to account for that in accordance with the sales type lease guidance that's in 842. And then finally, you could have a direct financing lease that remains a direct financing lease. And in that case, the net investment in the modified lease will not change. You're just going to adjust the discount rate so that the initial net investment equals the carrying amount of the net investment. So again, we'll walk through an example because I think it's the easiest way to kind of see how this accounting really works. So in our direct financing example, it is remaining, or it's changing to an operating lease. So again, at the top, we just gave you the characteristics of the original lease, so you can see why it was originally a direct financing lease. So it's a 4-year lease for a new piece of equipment. I want to just highlight the residual value guarantee by a third party. That is what makes this a direct financing lease, the third party guarantee plus the present value of the lease payments. And then our modification terms are at the beginning of year 3, we're going to extend the lease term by 2 years. And then a point to highlight here is that also with the modification is there's no residual value guarantee by the third party. So that is what kind of turns it into now being classified as an operating lease. Without that third party guarantee, it doesn't meet that criteria. So again, applying those steps we talked about. So step 1, does it qualify as a separate contract or to be accounted for as a separate contract? No, it's just a lease extension. There's no additional right of use granted. And then second, we're going to reassess the classification based on the modified terms. So again, as that third party guarantee was removed in the terms of the modification, it is going to not meet any of the direct financing or sales lease type criteria, and therefore would default to an operating lease. So then the next step, once you know the new classification, is to apply the accounting treatment based on that classification. So now the lessor is going to de-recognize the net investment and recognize the equipment. So that kind of ties to the piece in yellow, the carrying value of the net investment at the date of modification is what you're going to put your PPE on the books for. And then step 4, again, another piece of the accounting for this would be the lessor is going to recognize $17,000. That in the modification is $17,000 is the lease payment. So you'll recognize that. And then you're also going to now recognize the depreciation on the equipment since you put the PP&E on your books. So then the next slide, we'll talk about sales type lease modifications. So this is the last classification modification that we'll talk through. And these do kind of overlap with some of the direct financing accounting treatment for the lessor. So we're just going to touch on these more at a high level. But if you have a sales type lease that is modified to an operating lease, the lessor is going to recognize the carrying amount of the underlying asset equal to the net investment right before the modification was effective. If you have a sales type lease that is going to be modified to a direct financing lease or a sales type lease, the net investment in the modified lease won't change, but again, you'll adjust the discount rate so that the initial net investment is equal to the carrying amount of the net investment in the original lease. So I know that was a lot of information. So again, as Kristi mentioned, it's helpful to look back at these slides or walk through the examples to really understand how the accounting treatment is in a real life example. So before I switch it back over to Kristi, I'm just going to give you guys the second keyword. We're in a carb theme today. So the second keyword is going to be pizza. No other reason besides it's my favorite food. So again, the second keyword here will be pizza.
Thanks, Sam. So one of the topics that we said that we were going to revisit just at a high level is talk about embedded leases once more. I know we briefly mentioned it in Lease Webinar 1. We touched upon it again in Lease Webinar 2. So in the final Lease Webinar, I decided we'd hit it just one more time, give you a few other key things to look for when looking for embedded leases. So common places that we often talked about is IT contracts, server contracts, cloud-based data centers, advertising, managed services, postage meters, things like that, as well as contract manufacturing arrangements. I'm going to put you over to the little bubble. So the bubble says, you know, how am I going to find these embedded leases within a lease? Some key words that you want to look for within your leases are exclusive use. If you have exclusive use, that means you basically, there's an asset and you have substantially all the rights, of that asset. Solely, meaning no other person can utilize that asset. You have the rights to solely direct them how they're utilizing that asset for you, as well as an identification number. If there's an identification number within your lease that specifically identifies a piece of equipment for you, again, these are keywords that may determine that you have an embedded lease. So you want to look at it a little bit closer if you see any of those keywords within your lease. A couple examples that we had provided on here. I'm going to walk through the first one. You know, if you are a manufacturer, if you, let's say you're a shoe, so you sell shoes and someone manufactures shoes for you. So if a particular manufacturing plant, you're outsourcing it, you buy these shoes from this place, but they, because of the volume, have determined that there's a particular place with particular equipment and they're only manufacturing shoes for you, for nobody else, that might be considered an embedded lease. So just some key things to look at when embedded leases. If you're unsure, again, you can always ask your accountants, ask your auditors. You can reach out, look for those keywords, but anything where you have a right of use and you substantially obtain, you know, all of the benefits of that particular asset.
So now picking back up to related party leases. So we just wanted to touch on related party leases and see if there are any differences or considerations that need to be made with 842. Overall, there isn't anything that's substantially changed. So for classification, a related party lease would be classified just like other leases under the guidance in 842. For disclosure requirements, you would apply the related party transaction disclosures under 850. One thing to point out, though, is that under 842, it focuses on looking at the legal form of a related party arrangement and the enforceable terms and conditions, whereas 840 looked at the substance of an arrangement with the related party, which that aligns with the tax treatment. So there may be circumstances where you might have new deferred tax assets or liabilities. So that's just one thing to keep in mind if you have any related party leases as you're going through that, to kind of be aware of that change under 842. Our last topic will be sale leaseback transactions. So this little chart just shows an overview of like what a sale leaseback transaction is. So you'd have party A that sells an asset to party B. So party B becomes the buyer, but then party B leases it back to party A. So that's just a high level overview. And now we'll kind of get into the accounting and how to determine if you have a sale leaseback transaction. So the main thing that would drive whether or not you have a sale leaseback transaction is determining if a sale and purchase actually occurred. So you're going to apply certain criteria within 606. So there needs to be a contract. And then the second thing is there also has to be a transfer of control of that underlying asset. So the second point here is the more complex one, or the thing that changed more under 842. So that's what's discussed on the other side. So indicators of control. This could be a physical possession if you have legal title, risk and rewards of ownership if you've accepted the asset, a present obligation to pay. But these are only indicators versus criteria. So that's kind of one of the differences between 840 and 842. 840 really just focused on the risk and rewards portion, but here there's various indicators along with the control principle that you would want to assess to determine if control has actually passed. And then the control principle being, do you have the ability to direct the use of, and are you receiving substantially all the benefit from that asset? So how you assess control is a bit different under 842 than it was in 840. So once you've determined that, yes, we do have a sale and purchase, and we're going to apply the sale leaseback accounting, now we'll kind of walk you through high level what that accounting would be under 842. So at the time that the buyer obtains control, the seller lessee is going to de-recognize the carrying amount of that underlying asset. And then at this point, they would recognize any gain if there was any. And then you're going to recognize the transaction price based on the guidance in 606. Whereas the buyer or lessor is going to account for the purchase of that asset as you would any other purchase of a non-financial asset. So you would just apply that guidance to your purchase. And then the buyer lessor is going to apply the lessor accounting model, which we talked a little bit ago about. And then two final points just at the bottom to call out further differences for sale leaseback transactions under 842 is that if you have a finance lease, which would be on the lessee side, or a sales type lease, so on the lessor side, you cannot apply sale leaseback accounting. That's new under 842. There was no such exclusion under topic 840. So that is one thing to be aware of. So again, if you're a lessor and you have a sales type lease, you cannot account for it as a sale leaseback transaction. And then another difference is the requirement to recognize a gain immediately upon the recognition of a sale leaseback transaction. So again, you recognize it immediately under 842, whereas under 840, the recognition of that gain or loss was dependent on the rights retained by the seller or the lessee. So that kind of wraps up our sale leaseback topic.
Thanks, Sam. So that concludes our topics for today. While I give you a few administrative items again today, I do want to let you know if you have any questions, you can enter them into the Q&A or through the chat. If you do enter them into the Q&A, you can do it anonymously if you'd like. So feel free to do that as I'm giving a few of the administrative notes. Again, when we finish the question and answer period, if you still have the Zoom kind of like open, a survey should pop up for you to complete. Please make sure you put your 2 keywords into the survey. And then you will get the CPE credit. A certificate will be emailed to you probably by the end of the week. You will get a copy of today's presentation as well for completing that survey. And look forward to the recorded versions of all 3 webinars in this series sometime in December on our CTBK YouTube channel. And you can see my email here as well as Samantha's. Feel free to reach out to us if you can't think of any questions now, but maybe you have them a little bit later on. Feel free to email me directly. I'd be happy to walk through any of your questions that you have with you. Again, I highly recommend with this particular webinar, due to, how technical it probably is, to kind of get a copy of the slides, walk through the examples and see if that, answers any of the questions that you may have. If it doesn't, please reach out to me. I'd be happy to answer anything that you have, and we can go from there. So now I'm going to ask Caitlin, who's our moderator, just to check and see if any Q&A has come in.
Hey, yeah, we do have a couple questions, so I'll jump right into them. The first is, can the Lessor group lease and non-lease components?
So I think what you're saying, the question is can the lessor, so similar to the lessee, can the lessor group lease and non-lease components? There is a practical expedient, like there is for the lessee, for the lessor, that allows basically lease and non-lease components to be grouped together. So there is an option for that. You have to elect that practical expedient. I will say with that, be hesitant, because that could produce higher assets, a slower recognition of revenue. So you may want to be aware of that and make sure that you consider all options before electing that practical expedient. And, if you do want a full list of those practical expedients from the lessor or lessee side, again, feel free to email or reach out to me or your accountants. I'm happy to share any of those with you so you can see all the options that you have.
Thanks, Kristi. Another one is, can you expand on how the population of indirect costs for the lessor has changed?
Yeah. So in the lessor section, I had mentioned that indirect costs, the population has been narrowed. So what that's referring to is that under 842, you're only allowed to include any incremental costs of a lease that would not have been occurred if the lease hadn't been executed. So there are some costs like legal fees, or if you had allocated internal costs that were previously capitalized as direct costs, those will actually be expensed as incurred under 842. So again, under the new lease topic, there is just a narrowed definition of what can be accounted for as an initial direct cost.
Thanks, Samantha. We do have one more, but if anyone else is working on writing in a question, don't hesitate to send it in the Q&A, and we still have time to get to it. But we do have one more for right now. It is, does materiality play a part in lease accounting?
So let me take that. Yes, materiality does play a part. Although topic 842 doesn't specifically mention any materiality, obviously for financial reporting purposes, you do want to consider materiality. I will add, actually, I recently just found that the International Financial Reporting Standards actually does give a limit of $5,000 that says if you calculate a lease liability, and when you calculate that right of use asset, it's $5,000 or less, you don't actually need to apply the accounting standard. So funny that question should come up because I just happened to research that this morning, just getting ready for this topic. So yeah, so there's that.
Great, thank you, Kristi. That's all the questions that we received. But if you think of any other questions, feel free to reach out to Kristi or Samantha on the emails on the screen.
Yes, and thank you everybody for attending our lease webinar.